Okay, let's move away and talk to Nilesh Shetty, Associate Fund Manager of Quantum AMC, to understand his perspective on the markets. Nilesh, thank you so much for coming on board and a very good afternoon to you. Talk to us about how you are assessing the markets at this point of time, assessing the mood of investors and your clients at this point of time, and how are you navigating through all the uncertainty?
Yeah, given the rally that we've seen starting late Feb and sort of in the month of March, it looks like the market believes that the current dispensation, the current NDA government will come into power and with a strong majority for the BJP. If that does not happen, given the levels that we are at, there could be a reaction, and the reaction could be quite severe. So our sense is, given the rally, there is limited upside risk right now, and if sort of the event plays out contrary to what the market expects, you could see some downside in the market. As of now, some of our stocks have hit sell limits and we are exiting them, so the cash levels are increasing in the fund. But just the way the market is positioned for the near-term event, it looks like there could be a greater downside risk than upside potential in the near term.
Right. Looking at the sectors, which are the ones that you believe are reasonably priced at this point of time? Because, most people are quite wary at this point of time of sectors like consumption, auto, and even FMCG for that matter, because of the high valuation. So where do you see attractive pricing, attractive valuations at this point of time?
Yeah, so the fund follows a value style, and we sort of start looking at sectors where valuations are very attractive. So we have a large allocation to two-wheelers, given that last few years demand has not been that strong, given that rural India has had a problem. So valuations are close to cyclical lows for that sector. Again, they remain very attractive businesses with sort of mid-teens EBITDA margins and very high core ROEs for the companies and very strong cash generation. Post the IL&FS event, there has been a sharp correction in the NBFC space, and NBFCs that we think will sort of survive the turmoil and will offer decent growth is stocks where we've added to the portfolio. We've also added cement to the portfolio after some of them started trading at discount to replacement, given that there were fears of capacity coming in. But these are the pockets that where we found value for the portfolio.
Right. Okay. What about the earnings so far? How are you assessing the performance delivered across sectors and companies at this point of time?
Yeah, so last 4 years, there has hardly been any earnings growth in the sort of index companies. This year, in the first half of the financial year, it looked like there was some traction in consumer demand. But after IL&FS event, especially post-October, numbers have suddenly weakened across the board. And it's actually been quite a surprise for most people. If you see numbers in the auto space as well as consumer staples and other consumer discretionary spending, they have come off quite sharply after October. Again, our sense is it is more linked to credit and what is happening in the credit markets, especially the liquidity squeeze that happened post IL&FS, and so it's cyclical in nature, not structural. And our sense is it will recover in time once the credit markets normalize. But right now, I think near-term numbers will remain weak, at least for the next 1 or 2 quarters, till that normalization happens and until there is a pickup in demand. It looks like near-term numbers will be weak for most companies.
Established that you do like NBFCs at this point of time post the IL&FS crisis. What about banks, private or PSUs? How are you reading into their performance?
So in PSU banks, below the largest player, we've never really looked at the space, given that there are serious balance sheet and corporate governance issues there. So most of them sort of appear cheap, but they are sort of essentially value traps, given that the book might take a large hit and they might have to raise a lot more capital to meet capital adequacy norms. Private banks, unfortunately, have not been cheap. Some of the best names have always been expensive, and they've become more expensive post this credit event, given the quality of book that they run. There are selective private banks which have come off quite rapidly and where we think perhaps there is opportunity, which is what we've added to the portfolio. But again, the quality ones have not been cheap and they've not materially corrected. We would like to own them, but they remain at close to cyclical highs in terms of valuations.
All right, Nilesh, great chatting with you. Thank you so much for joining us and sharing with us your insights on the markets.